Good afternoon, Angelica.
Hi, Miss.
Hello, how are you, dear? Good afternoon.
I'm fine, Miss.
Angelica, just give me 2 to 3 minutes. Let's wait for Atif and then we are going to start.
Okay, no problem, Miss.
I think we can start. He can join because I'm not sure which time particularly is going to start. Okay, now my dear students, we are going to start with our last left topic, that is regarding investment appraisal again. We were considering about the real cash flows and the money cash flows in our last lecture. So as you can see the requirement of the question that evaluate the project in terms of real cash flows and real discount rates, money cash flows and money discount rates. I have told you people that the discount rate which is given in front of us, the cost of capital, can be without incorporation of inflation in it, and with the incorporation of inflation also it can be present in front of us. So I told you the formula, that is 1 plus I is equal to 1 plus R into 1 plus H. Do you remember? Over there, I is money rate of capital, money rate of interest, H is rate of inflation, and R is real rate of interest without the incorporation of inflation in it. So here they are telling us that evaluate the project in terms of real cash flows and real discount rates. Whenever we have to follow this method, it means that we need the discount rate without the incorporation of inflation in it. Real rate of interest we do require. And on the basis of that, we are going to discount our cash flows and we are going to calculate the NPV in order to evaluate the project. Whereas part B tells us to calculate the money cash flows and money discount. Over here, what we are going to do, first we are going to incorporate the factor of inflation in our cash flows. This will be converting the cash flows into money cash flows. Then using money discount rate, we are going to convert them into their present value, and then we are going to calculate the NPV in order to evaluate the project. So let's start with the first one. Let's read the scenario. A project has the following cash flows before allowing for inflation. So before allowing for inflation, a project has the given cash flows, which are stated at their TO values. TO values means in current terms, the values are there. From year one, you have to incorporate the changes in them. Anyhow, because these are real cash flows, we are not going to incorporate the money factor in them, the inflation factor in it. The company's money discount rate is 15.5%. The general rate of inflation is expected to remain constant at 5%. So my dear students, in order to calculate the real cash flows, we need real discount rate. So use the same formula. What is that? 1 plus I is equal to 1 plus R into 1 plus H. 1 plus I is how much? 15.5%. Please calculate it. 1 plus R needs to be found out. H is 5%. So please simplify it. How much R are you getting? Angelica, tell me how much R are you getting?
It is 0.1.
0.1. Okay, 0.1. It means that it is 10%.
Yeah.
Got it? 0.1 multiplied by 100. R is our 10%. Now, my dear students, the real cash flows using the real discount rate has to be solved. Can you start doing it? Start doing it. The discount rate would be, discounting factor would be 10%. Start discounting the cash flows. We are not going to make any change in the cash flows. The cash flows are going to remain the same. Angelica, can you see the board? We are not going to make any changes to the cash flow when we are doing this method, real cash flows. So just tell me the discounting factor for 10%. For 10%, for year 0, it is going to remain 1. For year 1, it is 0.909. Please tell me if I don't make any mistake. For year 2, it is 0.826. For year 3, it is 0.751. Now convert them into the present values. Can I write the present values here? For year 0, it will remain the same.
0.909 and next one 0.826.
Yes. You have 10%. Are you seeing the present value table? Don't see the NVT. Don't see NVT, okay? It's present value. When you are seeing the figures in collection, over there the NVT is going to be used, okay?
That's what I was.
Angelica, do you have the formula sheet with you? So we have written the discounting factors for 10% from the formula sheet. Now Hashir, calculate and tell me 330 multiplied by 0.909. How much it is?
200.97.
300? Okay, yes, we can round it. 242 multiplied by 0.826.
200.
200, okay. 532 multiplied by 0.751.
400.
400. Calculate the NPV.
150.
100. Positive. 100, 151.
Yeah. No, it's 150.
150. Students, whichever method you are using, you will be getting the same NPV. Please keep in mind. Please give me a while, students. Let me call up if I hope he is not getting the way to the classroom.
They will guide. I was checking that way. They told me I can't. So they're same plus security.
Good afternoon, Atif. Sorry, I had just seen your message here. Can you please ask security or someone to guide you to this room? Just tell me. It's not on the same. It's not on the same side. It's just on the opposite side. You know about the registration department. Just next to the registration department, take left. Yes. Please come. Angelica, did you get the same one?
Yeah, Miss, sorry, I couldn't answer you earlier because I had a call.
Sorry.
I couldn't.
Please repeat again.
I couldn't answer you earlier when you were asking the question.
No, it's fine. It's fine, dear. It's fine.
Yeah.
No problem.
Yeah, but I got 150 as well.
Okay, great. Now let Atif come. We are going to start. Don't think that I'm using mobile phone in the class. It's just a book. Good afternoon, Mr. Atif. How are you? I'm really sorry today. I didn't wait for you, and I received your message a little bit late. Anyhow, let me just repeat it for you. I was trying to start the class in time so that we can. Atif, if you don't mind, please sit over there because I'm having a little bit flu, and I'm trying to be a little bit careful. It's fine. Are you able to see it?
Yeah.
Okay, great. Okay, now the question, this is the first question we had started actually, and it's just from the previous discussion which we had done regarding real rates and money rates. Okay, do you remember? So we had discussed about the formula of 1 plus I is equal to 1 plus R into 1 plus H. Without the incorporation of the inflation, the discount factor is R. And with the incorporation of inflation in it, the rate of interest is I. The formula, Fisher's formula, 1 plus I is equal to 1 plus R into 1 plus H. Now the question has been telling us to evaluate the project. Evaluation of the project means to calculate NP. Got it? Evaluate the project in terms of real cash flows and real discount rate. Whenever this type of condition will be given to you, it means that you have to use real discount rate. If they have given you the money discount rate, you first need to convert it into the real discount rate, and then you will start doing your work. Suppose we had converted this discount rate into the real discount rate, and then we are not going to give any kind of effect to the cash flows because they need to be in the real terms. So simply with the help of the discount factor, we are going to discount them and we are going to calculate the cash flows, discounted cash flows. Got it? So 750 multiplied by 1 at the 10% to the table, you can see the present value table. Under 10% for year 1, it's 0.909. Do not see the annuity table, present value table. Then 0.826 and then 0.751. And we had calculated the present value and we had calculated the NPV for this particular project. Are you clear? This is what we have done. Yes, dear.
That we are using the discount rate is 15.5% to convert 15.5% into the 10%. So we have used that formula.
We have used that formula because this is the particular approach which we have to follow in order to go for this one. We cannot use the money discount rate while we are having the real cash flows, and real discount rate has to be used. Okay. Now come to the second one, money cash flows and money discount rate. What is the difference among these two methods? Whenever the money cash flows have to be taken, whenever we have to convert the real cash flows into the money cash flows, we are going to use the money discount rate in order to discount them first, in order to convert them to the money cash flows. After they are going to be converted to the money cash flow, we are then going to use the money discount rate in order to convert them into the present values. Okay, now start doing it. This is the only difference among these two methods. Sorry? First, over here in the real discount factors, we have not converted them into the money cash flows. But in this case, we have to first convert these cash flows into the money cash flows, then use this discount rate in order to get the present values. And there can be a problem for you that how are you going to use this 15.5%? Because over there in your table, you do have only whole numbers. So what are you going to do?
16.
No, you cannot round it.
We need to use this formula.
This formula, not this one. In order to discount, what is the formula? For discounting, what is the formula? Cash flow multiplied by 1 over 1 plus r raised to the power n. So that one you are going to use in this case then. Okay? Start solving. And the NPV you are going to get the same. Whichever method you are using, the same NPV you are going to get. Students, don't think that I'm using mobile phone in the class. It's just a book, which I am having a look at the mobile phone. Yes, Hashir, have you converted to the money cash flows? No, not yet. Dear, use this rate to convert into the money cash flows.
Can you help?
Sure. Can I erase it? Now, students, we do not need to get the discount rate because money discount rate is already given in the question. First, we are going to convert them into the money cash flows. This is the only difference among two methods. So we are going to convert these cash flows into the money cash flows using this particular rate. So this 750 is going to remain the same because it is already in the real terms. Okay, then this 330, 1 plus R, 0.05. Which year it is? 1. Then 242, 1 plus 0.05. Which year it is? 2. Then 532, 1 plus 0.05 raised to the power 3.
Now we go to
Convert it, sorry.
there was a confusion, money cash flows and discounted cash flows.
Money cash flows. This is money cash flow. Now we are going to discount them. Now we are going to discount them using money discount rate. In the real terms, we do not need to convert them into anything. Simply, we are going to discount them using real discount rate because they have to be in real terms only. Got it? So this is the extra step which we do in the case of money cash flow. Now, Hashim, can you tell me the answers? The first one is 750, the second one?
346.5.
Sorry?
346.5.
346 we can take, okay.
267.
267.
616.
616. Okay, now what is the next step? Now we have to discount. Take the discount factor. Discount factor is 15.5%. So what we are going to do? As I told you, we are going to use the formula of 1 over 1 plus R raised to the power n. So it is going to remain 1. At 0 term, it is going to remain 1. Then for every cash flow, 346 multiplied by 1 over 1 plus R. Which rate we are going to use? Money rate. That is 15.5. 15.5% raised to the power 1. Then 267, 1 over 1 plus 15.5% raised to the power 2. 616 multiplied by 1 over 1 plus 15.5% raised to the power 3. Like this you are going to do. 15.5 will become how much? 0.155.
Very good.
Yeah, this one. 15.5. I have simply written 15.5%. It will be 0.155.
1.1.
Okay, so how much it is? For the first one, it will remain.
0.06.
Yeah, just give me a one from college. Hi, good afternoon. Good afternoon. Miss, I am in the class right now. If there is something urgent, you can just tell me. Okay. Okay, so on Sunday or on Saturday, I will be coming to the college again. So I will provide that at that day. Is it fine? On Saturday, will you be there? Okay, sure. On Sunday, I will provide it to you. Thank you so much for informing. Thank you, dear. Goodbye. Okay, so 750. Then dear, for this one.
Do we need to multiply by 100?
Which 100?
1 over 1 plus 15.5.
15.5?
Yeah, 15.5.
Divided by 100. Percentage means divided by 100. So you will be getting 0.155. 0.155 plus 1 out of plus 1.
0.606. 1 more.
No, for this discounting factor, you are getting this one. Okay, whatever you are getting multiplied with 346.
Yeah, around 300.
300. The same ones you are going to get.
Yeah, not same, also.
All same? 200 and, Atif, are you clear? If you are not clear, tell me.
My answer coming is 20.96.
20.9, let me just help you. Give me here. This 15.5 divided by 100. This is the negative percentage. 0.155 plus 1. 1.155, 1 divided by R. It's raised to the power 1, so we are going to remove it. Multiplied by the cash flow is 346. So 290, 300. Okay. And for the next one, we have to take the power also. I think that you are not able to see from here.
Yes.
From here, it's fine.
Is it fine now? So what you are going to get, NPV will be 150 again. Now in the next step, please take the power of 2 because we are now in year 2. Angelika, did you get the answer? Same as 150?
Yes, miss. 150 as well. Yeah, I got it.
Okay, great. Done? Okay. So are you clear, Atif? Okay. Okay, now students, let me just erase it. Let's have a summarized discussion regarding the 2 types of inflation. Actually, there are different types of inflation which we do classify the inflation as like hyperinflation, etc. Stagflation is there, but it is not about those types of inflation. It is about the types of inflation which are going to be considered in your paper of financial management. 2 types of inflation which you can encounter in your exam is the general inflation and the specific inflation. General inflation is the type of an inflation which is going to affect all of the products and services in general. Specific inflation is a type of an inflation which is going to affect some products specifically. So there are 2 types of the inflation in the market. Obviously, to some products and services, the inflation specifically affects. And on the other types of the products and services, it affects generally. Now, as they say, specific inflation rate impacts all the individual cash flow items. If there is a specific cash flow given in your exam, you are going to encounter it together with the individual cash flows. You are going to take an effect for the individual cash flows. Each cash flow is affected by the specific rate. When there is a general rate of inflation, it impacts all of the cash flows in the general rate. So it is going to be affecting all the cash flows in general. Impact the investors' overall required rate of return. Investors in the project needs compensation for their lost purchasing power, which relates to their ability to buy a basket of all goods rather than any specific one. So you must need to keep in your mind that general rate of inflation affects all the items generally, whereas the other one. Do you want to have a look at? The specific inflation rate is going to affect the products and services individually. Shall I move on? Okay, now, in the exam or in the financial management paper, what do you need to consider? When do you have to use the money method or the nominal method, and when you are required to use the real method? My dear students, if more than 1 inflation rates are given to you, you are going to use money method. This is the key. Okay, when there are more than 1 inflation rates given to you, you will be going for the money rate. If there is 1 inflation rate given to you, you need to consider that whether the cash flows are in real terms, in current terms. If they are in real terms, you will be going for the real method. If they are in money terms, you go for money method. Got it? So this is what you keep in your mind. Okay, now this is what we have done earlier also. They have just summarized it. To convert money cash flows into the real cash flows, if the money cash flows are given to you and you have to convert them to the real cash flows, it means that you have to deflate them. You have to decorporate the inflation factor from those cash flows. So to convert nominal cash flows or money cash flows into real cash flows, they need to be deflated using the general inflation rate. So when you have to deflate them, use the general inflation rate. They say current cash flows, in order to convert them money into money cash flows, inflate using specific rate. And when money cash flows have to be converted to the real cash flows, deflate using the general rate. However, do not confuse yourself, because in exam, your practice will be built to such an extent that you are not going to consider these things in your mind. Your practice will be built in such a way that you will be encountering the questions as a normal habit. So current and real cash flows will only be the same. These real cash flows and current cash flows will be the same only if your specific rate of inflation and general rate of inflation are same, which is normally not the case. So current and real cash flows will only be the same if the specific inflation rate used for the cash flow is the same as the general inflation rate. Exam key, in the examination for short life project with cash flows inflating at different rates, it is best to set the NPV calculation out with the cash flows downside and the time across the top. So they are just giving you a suggestion that when there are short life projects, give the timing on the top 0, 1, 2, 3, 4 project life, and on the downside you can just mention the cash flows. Got it? Okay, now here is understanding number 5. Let's see how is it going to be applied. Evaluate the project assuming that the machine has a life of 5 years and no scrap value. What is the meaning of evaluating a project? We need to calculate the NPV, net present value has to be calculated. Assuming that machine has a life of 5 years. The machine life is 5 years. So on the top, please mention the life of the project 0 to 5. 0, 1, 2, 3, 4, 5 on the top. And downside, you are going to mention the cash flows. Let's read the scenario. A company is considering a cost-saving project. This involves purchasing a machine costing 7,000. So initial investment is how much? 7,000, which will result in the annual savings in real terms. Look, they have mentioned the annual savings are in real terms. On wages cost of $1,000 and a material cost of $400. The following forecasts are made of the real rate of inflation each year for the next 5 years. So for wages, materials, and general prices, we have different rates of inflation. The cost of capital of the company in real terms is 8.5%. So my dear students, when the specific rate of inflation is given, what you have to do? First, you are going to incorporate the inflation individually in the given products or items. So you are going to inflate wages and materials as per these rates. Can you do it? On the top, please mention 0, 1, 2, 3, 4, 5. This is the life of the project. Downside, please mention the things. Investment is there. Initial investment. How much it is? 7,000. Then students, we do have materials. Materials are in current terms. They have to be inflated. They are in real terms. They are going to be inflated using this 5%. Can you do it for first year? What is the material cost? 400. For first year, 400 into 1 plus R. What is it? 0.05 raised to the power n. That is 1. What is the answer you are getting?
420.
In exam, do not show this. In exam, Excel sheet will be provided to you. Okay. So do you know how to use the Excel sheet? I hope all of you do know. So when it is equal to, you are just going to put the formula. Examiner themselves are going to see.
420.
420. Now on this 420, apply the formula. 1 plus 0.05. Do not need to incorporate 2 in it on. Now
441.
441. Now on 441.
463.
463. Now on 463.
486.
486. Now on 486.
510.
510. Do the same for wages now. What is the current rate of wages? It's 1,000. Can you do the same for wages? It's 10% for wages. Sorry? 1,100. Then,
1210.
sorry,
1210.
1210.
1320. 1320.
1320.
1440. 1560.
144015.
1331.
1331. Sorry.
Is it? No. Is it 1440?
There's a mistake.
Number
Yes.
3. Here number 3.
From number 3.
Here number 3. 1331.
1331. For number 4?
1464.
1464.
1610.
Sorry?
1610.
1610. Total then? Students, these materials and wages are savings, okay? So they are going to remain positive. Please do consider this line, which will result in the annual savings, okay? These are savings. So this is going to remain 7,000. And this one, 1520. This one,
1651.
1651.
1794.
1794.
1950.
1950.
50. 2120.
120.
2120. Now, my dear students, what is the next step? You have to apply the discounting factor. Which discounting factor is going to be applied?
8.5%.
8.5. It is in real terms.
Yeah, we need to convert it.
We need to convert it into money rate because we are going according to the nominal method. So which formula we are going to use? 1 plus I is equal to 1 plus R into 1 plus H. 1 plus R is calculated. Yes, dear, 1 plus R.
8.5.
Yes, 8.5.
This is 1.8 will be general price.
Yes, general. Ashir, are you understanding, dear? How much I you are getting?
$1.15. So that is
1.15 minus 1, it would be 15%. Adit, did you get the same? So discounting factor of 15% is going to be used in order to discount. So now see from the tables, over here it will be 1. At 15%, see the rates, just apply them and calculate the NPV. These will be the present values. These are net cash flows. Students, if I do any mistake, please let me know. 572. Okay. Are you getting the same discounting factors?
78 negative.
1000,
78 negative.
1078 negative. Asha, are you getting the same? Let me check it.
1081, yeah, kind of.
Yes, it's 1081. Yes, in the book also it's 1081. So this is just a slight difference because of rounding only, okay? So are you clear, students, now? We have used money method in this illustration also. May I erase it? And Shika, are you clear, dear? Are you getting the same NPV?
Yes, Miss.
Okay, great. Okay, now students, we are step by step moving ahead. We have started with the incorporation of inflation in the investment appraisal questions. Now we are going to see the impact of corporation tax on our investment appraisal. So whenever there is a corporation tax, we need to consider that the cash flows which we are considering in the investment appraisal are obviously going to carry the amount of tax in them as well. Whatever cash flows are there, they are going to bring some tax implications for the company also. So we need to consider them also. They say impact of corporation tax. Tax is charged on the operating flows. Additional income is equal to additional income tax paid. And additional cost is equal to less tax paid. The more the cost is going to be there, our net cash flow will be lesser, bringing the lesser tax to us. And the other thing which we need to consider is the tax relief on investment spending. Do you remember tax allowable depreciation? When we are financing into any kind of the asset, that will be bringing tax allowable depreciations to us. So that would also be the considerable factor for us. So they say tax allowable depreciation allowed as an expense against profits instead of depreciation. Okay. Here the detail is written, NPV incorporating tax impact on cash flows. Corporation tax charged on the company's profit is a relevant cash flow for NPV purposes. It is assumed unless otherwise stated in the question that what assumptions you are going to keep in your mind regarding taxation in corporation. Operating cash flows will be taxed at the corporation tax rate, and this corporation tax rate 30% normally, 20%, whatever it is will be given to you in your exam question. Operating cash flows will be tax deductible and attract tax relief at the corporation tax. So whatever cash outflows are there, you are going to consider that they are deductible. You are not going to consider that whether they are allowable deduction or not. You will be assuming that they are going to be deducted and tax relief will be present. Investment spending attract tax allowable depreciation. So whatever investment you are making in an asset, it will be attracting a tax allowable depreciation. You are going to calculate the tax allowable depreciation unless stated otherwise. The company is earning net taxable profits overall. This avoids any issues of carrying losses forwards to reduce future taxation. So you are not going to consider that previous losses are carried forward in order to set against the current profits. Tax is paid 1 year after the relating operating cash flows is earned, unless told otherwise. If nothing is told that how the taxation is being paid, you are going to consider that 1 year in arrears it is getting paid. Say for example, in 1 year, in first year you are making the operating cash flow. In the second year, taxation will be there. This is a normal assumption. And normally in the exam questions, they do mention that in 1 year arrears, the taxation is being paid. Next, for tax purpose, a business may not deduct the cost of an asset from its profits as depreciation in the way it does for the financial accounting purposes. Instead, the cost must be deducted from taxable profits in the form of tax allowable depreciation. So the tax relief brings on the factor of tax allowable depreciation. Do you remember how do we calculate it? We are going to calculate the depreciation on that. It will be bringing a relief for the company. So that relief is going to be considered as the cash flow. Tax allowable depreciation, also known as WDA, writing down allowance, is calculated based on written down values of the assets. This will be either on the reducing balance or straight line. Read the question carefully. In the total amount of tax allowable depreciation given over the life of an asset will equate to its fall in value over the period. That is the cost less any scrap proceeds. So the total tax allowable depreciation will equate to the cost and deduction of scrap values. You can counter check also that whether your calculations are correct or not. If your total tax allowable depreciation is not equal to the cost less scrap values, it means that you have done something wrong. Tax allowable depreciation is claimed as early as possible. So you are going to consider in the year in which the taxation is being calculated. In the same year, you are going to consider the tax relief, tax allowable depreciation also. Tax allowable depreciation is given for every year of the ownership except for the year of disposal. And this is the taxation rule. Instead of year of disposal, on the other years, you are going to take the tax allowable depreciation. And in the year of sale, a balancing allowance or balancing charge arises. How is it going to be calculated? We are going to discuss in our practical question. So this is the pro forma for this one. Writing down allowance, original cost of an asset less cumulative tax allowable depreciation claimed. We are going to get the written down value of the asset. By deducting disposal value of the asset, we are going to get the balancing allowance or balancing charge. If the disposal value of the asset is more than the written down value of the asset, we are going to get the balancing allowance. If it is lesser than the written down value of the asset, we are going to get the balancing charge. Got it? Anyhow, we are going to see practically also. Here in understanding number 6. Sure.
We need to adjust the gain on disposal and
Sorry?
gain and loss of disposal.
No, that would not be considered. Gain or loss of disposal. Done, Hashim? Okay, great. Okay, now understanding number 6, students, let's see the requirement first as usual. Calculate the tax allowable depreciation and hence the tax savings for each year if the proceeds on the disposal are 2,500. The proceeds on the disposal, the scrap value is 2,500. If this is the case, what would be the writing down allowance for each year? What would be the tax allowable depreciation? Students, tax allowable depreciation, the total of tax allowable depreciation is equal to the cost minus scrap value. Got it? Now let's read the scenario. An asset is bought for 10,000. This is the cost of an asset and will be used on the project for 4 years, after which it will be disposed of. Tax is payable at 30%, 1 year in arrears. So they have mentioned. And tax allowable depreciation is available at 25% reducing balance. So how much project life is there?
4 years.
4 years. So for how many years we are going to calculate the tax allowable depreciation? Very good, 3 years. 1 year deducting because in the year of sale, tax allowable depreciation would not be there. So how are we going to calculate it, students? Cost is 10,000 minus depreciation. Depreciation rate is 25% reducing balance. So how much it is? 2,500. 7,500 is remaining. This is for year 1. Second year? Yes, on 7,500 take 25%.
175.
1875. Balance
5625.
5625. Again, take depreciation.
This is not the
Sorry,
secondary depreciation should be with taking 20%.
25%. 25% here. It's written 25% reducing balance. Okay. Then for the third year, on 5625,
It is 1406.
1406. How much balance?
4219.
4219. 4-year life is there. So we are going to deduct the scrap value now, the disposal proceeds. How much disposal proceed is there? 2,500. So is this a balancing allowance or balancing charge?
It's allowance, right? What are you talking about?
But what the balance which we are getting, this is a balancing allowance or the balancing charge? Okay, anyhow, please calculate.
Allowance, right? After disposal.
Okay, let's calculate it first. We are going to discuss that later.
2719. Oh, sorry, 1719.
Sorry,
1719.
1719.
19.
Okay, now tax allowable depreciation. Yes, Arthur. First to it, we are going to discuss it then. Clear up till here? Okay. Now we are going to calculate the tax allowable depreciation. Tax rate is 30%. As per this 30%, we are going to calculate the tax allowable depreciation. So on this 30%, how much it is? Sorry?
750.
750. On the next depreciation, 30%, 563. On this one, 422. This one,
Which one? 1711. It is 516.
51. Total it. Sorry,
225.
2251.
51.
Angelica, are you cleared?
Yes, miss. Yes, miss.
Yes, dear, are you saying something?
No, I said I was clear.
Okay, okay, great. So this is 2 to 5. Yes, dear.
Considering the thing that was standard says that.
Sorry?
Standard says that no depreciation in the month of disposal. So we have to think about it for the year of disposal. We have to consider full year depreciation.
Actually, standard does not tell us. Standard gives us the right to do this also. That if we are not using, the proportionate basis, for monthly basis, we are not calculating the depreciation, then in the year of the disposal, we do have a right that we should not be taking a, depreciation in that one. But this is a separate thing. This is for the tax allowable depreciation. You can interrelate both of these, but actually it is not related to that one. Okay, this is related to the taxation. Taxation authorities also tell us the same thing, that the year of the disposal, because we are going to calculate the balancing allowance or the balancing charge. So my dear students, this is a balancing allowance. And please recheck that whether it is equal to this one or not. Cost is 10,000. Scrap value is 2,500. Multiply by 30%. How much it is?
2250, right?
2250? 2250. So it is the same. Got it? This is how we are going to calculate the tax allowable depreciation. Okay, now we are telling how would your answer change if the asset was sold for 5,000? Are you clear up till here? So I would be, yes.
Small fixed step we did.
Sorry?
The small fixed step we did. This answer. Why are we doing the?
Because this is the requirement of the question. When you are going to incorporate it into the investment appraisal, then you have to incorporate these into your question then. Because these are the tax reliefs. So you are going to write it in your investment appraisal question then, okay? Otherwise, it's simple. Okay, now, if you are clear up till here, I'm just going to incorporate the next one into over there only, okay? So because now your second step is telling how would your answer change if the asset was sold for $5,000. So instead of 2,500, Atif, look here, instead of 2,500, now they are telling the asset will be disposed for how much? 5,000. So how your working is going to be changed for that. So if the asset is going to be changed, disposed for 5,000, 5,000 only. So there could be a balancing
Profit.
charge,
Yeah,
not profit.
yeah.
How much it is?
71.
781. Calculate 0.3 on it, how much it is?
34.
234. Now, how much total relief you are getting? 750 plus 563 plus 422 minus 234. This is the difference.
Oh, 501.
1,000?
501.
1,501.
Yeah.
And you see, is it the same or not? Do you see? Can you see? Recheck. Okay, now students, part C. Calculate the NPV. Okay, if net trading income from the project is 8,000 per annum based on your answer to part A, that one. And the cost of capital is 10%, calculate the NPV of the project. Students, can you try this by your own? Just one step you need to incorporate in your calculation, that is about tax relief. Take taxation 30% on your cash flows of 8,000. Two steps actually you can incorporate. Take taxation of 30% on your cash flows of 8,000. Take the tax relief, that tax allowable depreciation, not this one, the one which we have calculated in part A. That one you need to incorporate in your calculations and calculate NPV. If you feel any problem at any step, do let me know. Yes, dear, please tell.
I don't know, like, I feel the answer I know, but I don't know how to start writing. Seriously, I get.
Just follow that approach. Write the years on the top and top down the cash flows.
4 years.
4 years. 0, 1, 2, 3, 4. From 0 it is because investment is always made in current terms. No, dear.
For disposal.
4 years. It's for 4 years, Hashim. It's written.
Yeah, I know.
Investment year is not going to be included. Actually, not only 4 years, make 5 years because taxation is in 1 year, 8 years.
Yeah.
Okay, so do incorporate that also. Project is for 4 years, but you are going to make the calculations for 5 years.
This tax relief should be applied in the next subsequent year, like for example, like.
Yes,
First
yes.
year, second year.
Second year, very good. Cash flows will be starting from year 1, but tax is going to be started from year 2. And same is the case with the tax relief
How
also.
about this one, disposal of assets?
Yes, this is also going to be incorporated in year 4. It's a cash inflow.
I'm getting 5 minutes.
Sorry?
Just want to. One of my cousins writing exam. She's writing an exam.
Okay, which one? F1? Do you want the mocks for that?
No, she's writing an exam. She just finished the exam.
Okay.
So it's kind of.
Okay, okay. You were teaching? Look the attention of the teacher.
Not like that. Let's come to this.
Sure, sure, sure. Atif, today, inshallah, we are going to finish our investment appraisal. And I'm just planning to take a test for that whole portion. In our next lecture, can we do that?
Yes,
Because I just want you to revise the exam kit as well.
yes.
So book we are doing right now, with the passage of time, we will be doing the book. But for exam kit, just revise the exam kit. And next, maybe on Thursday, we are going to have a holiday again, fortunately. So on Thursday, anyhow, we have to conduct a test. And we are in time, inshallah, we are going to finish our syllabus in time, don't you worry about that. So if it's possible, online, can we conduct a test on Thursday? Thursday, is it fine for you?
Yes, sir.
Because maybe you have some holiday plans or something like that. It's not yet announced from the college side, but because since it is a public holiday, so I feel that there would be.
What is that? But early morning, like 2 hours.
Okay, because it is going to be a test.
Yes.
So what I mean to say that please try to revise the concepts from the exam kit now for investment appraisal. I have not yet told people to go through the exam kit because once we will be finishing all the investment appraisal, then only you would be able to do the exam kit questions, since it is containing all of the concepts in it in exam kit questions. So, shall I do it, Atif, if you're having a problem?
I have done something.
Sure.
18,000.
18,000. Okay, let me just check from the book. 563, 422. And what was the last relief as per the last question, as per part A? What was the last tax relief?
1719.
No, tax relief for the last one. 1719?
1719 515.
515 or 516, I think it was.
Yes.
Okay, now. Is this the same? Are you doing it in the same way, Atif?
Yes. But I missed one thing, like I missed the tax.
Okay, yes, tax has to be added.
$8,790.
8,791. Okay, are you giving the same cash flows? Oh, one thing we have missed. That one, disposal proceeds. Have you written them?
Yes.
Disposal proceeds of 2,500. Yes, where are you confused at?
Because I will apply the discount rate, but your cash flow.
No, I have not applied the discount rate yet.
Is fine, cash flow same.
Same? Okay, fine. And discount factor of cost of capital is 10%. For 10% you can apply. It's
909,
0.909,
0.826,
0.826,
0.751,
0.751,
0.683,
0.683,
0.62.
621. Okay, now you can calculate the NPV.
7 to 7 first year.
72.
7.
Okay.
Four, 4828.
4828.
Or 628.
4628.
I made 2-1.
5821. And this one is 1884 into 0.621.
1170.
1170. And here it is 10,000. So how much NPV is there?
$11,370.
Is it positive?
Yeah.
11,379?
370.
Okay. Okay, in book it's 11,796. 7272 5245. This one is coming as 5245. This calculation, it's wrong here. 6350 multiplied by 0.826, there is a mistake. Anyhow, it's okay because the method is same. It's fine. 4628 5821 1170. Only the mistake is over here. Calculation problem is there. So are you cleared? Angelica, are you clear, dear?
Yes, Miss.
Okay, dear. May I erase it? Now we are going to learn that how can we incorporate working capital. So in investment appraisal, we should be knowing that how can we incorporate inflation, how can we incorporate taxation, and now the third thing, how can we incorporate working capital. As we do know that working capital is a type of the capital which is required to run the daily business of the organization. So for day-to-day running of the business, whatever investment we do require is known as working capital. So we have to incorporate working capital also in our investment appraisal technique. So they say investment in a new project often requires an additional investment in working capital. That is the difference between short-term assets and short-term liabilities. So the excess of short-term assets over to the short-term liabilities is known as working capital. Asher, we have finished the previous question.
Fine.
Has she passed?
Yeah, it was.
Oh, that's great. Okay, now we are learning how to incorporate working capital in our investment appraisal. So initial investment is the cash outflow at the start of the project. If the investment is increased during the project, the increase is a relevant cash outflow. If the investment is decreased during the project, the decrease is a relevant cash inflow. At the end of the project, all the working capital is released and treated as the cash inflow. To calculate, they have written 2 steps, but do not read from here, you will be simply confused. Do this understanding so that we can know. Okay, so that we can know that how can we incorporate the working capital into our calculation. So requirement of the question is calculate the working capital flows for incorporation into the NPV calculation. So they are not requiring us to calculate the NPV, we are just required to calculate the working capital flows. We can see that how can we incorporate the working capital into our investment appraisal questions.
What is the formula for this?
No formula. No formula is there. There is no formula, they were just explaining these steps, okay? A company expects sales for a new project to be 200 to 25,000 in the first year, growing at 5% per annum. The project is expected to last for 4 years. Working capital equal to 10% of the annual sales is required and needs to be in place at the start of each year. So my dear students, the life of the project is 4 years. Do make a table for that. 0, 1, 2, 3, 4. You need to calculate the sales as working capital is 10% of the sales. So for sales, what they say? Initial investment. Okay, expectation of the sales is 225,000 in the first year. So in the first year, the sales are 225,000, growing at 5% per annum. So incorporate the growth factor in it. 1 plus G raised to the power
236. Second year, 236.
Wait. The first year grade. Okay, yes. How much it is?
436.
236,000.
250.
250. Okay, then
248,063.
063. Then
Wait now. For the year 2, that's 63, right? No, for the year 2, you take the N is 2, right?
yes.
So when I do the same thing, like 225,000 to 1.05.
I do not have scientific calculator.
Yeah, so 1.05 raised to 2.
Okay, what's your answer? Let me just compare from them quickly so that you can.
I got 248, just that's what he got.
This one is illustration.
Yeah, what he got in the third year, I got in the second year.
It's 236,250.
Yeah, but 22500, right?
No, dear, no. Harsha, if you are incorporating from this figure, then there is no need for taking the power of n. So 225,000, 1 plus.
Okay, doing that 1.
1 plus, yes. 1 plus 0.05 into 225,000. So yes, 236,250. Now on this one, multiply by 1.05. It's 248062. Yes, 248063. Okay, then the last one.
260,466.
260,466. Okay, now working capital is 10% of the annual sales, which is required to be in place at the start of each year. So 1 year before. Working capital requirement is how much? 10% of the sale. 225,000 multiplied by 10%, 225,000. This one, 236,250 might multiply by 10%, 236,250. 10% of it, 24806. 10% of it, 26047. Got it? This is the working capital requirement. Now, what should be the working capital to be injected? difference we are going to take to 22,500 minus 0. In the first year, full 22,500 is going to be required. In the next year, then 23625 minus 22500. In the next year, this much is going to be required. In the third year, 24806 minus 23625. In the fourth year, 26047 minus 24806 is going to be required. Can you please tell me? In the first year, how much are you going to get? How much working capital is going to be injected then?
1,120.
1,125. Okay, very good. In the next year then?
1,181.
Very good. Here in the first year, how much is going to be injected?
22,500.
500 total. Okay, then in the first year,
1125.
1125. Difference of these?
1181.
1181. Difference of these?
1235.
4-1, right? Oh, wait.
26047 minus 24806.
1-2-4-1.
1241. And in the last year, what are we going to do? All of the working capital is going to be released. 26047. It is going to be positive. This is how the working capital is going to work. This is the calculation which we need to do. And this is going to be the working capital calculation to be included. These. This is the working capital to be injected. Got it?
Do we need to accumulate total and
Sorry?
do we need to accumulate all?
No, not for every year. For every year, we have to see that how much working capital has to be injected. Now, all these workings will be incorporated into the investment appraisal question as well. Got it? So yes, we have the right one. 2250011251181 1241, and in the last year it is going to be released. Got it?
Yeah.
Okay, now we have one more understanding, students. Calculate the working capital flows. Okay, is that the same? No. Calculate the working capital flows. A company anticipated sales for the latest venture to be 100,000 units per year. The selling price is expected to be 3 per unit in the first year, inflating by 8%. So in the first, students, you need to consider that whether the price given to you is in the first year or in the real terms. If it is in the real terms, then from year 1, you are going to inflate it. Over here, because this price is in year 1, so in the first year, you are going to take 3. Then you are going to inflate it for further years. Over the 3 years life of the project, working capital is equal to the 10% of the annual sales is required and needs to be in place at the start of the each year. So the same type of question is here. Can you start doing it by yourself? Quickly.
So the previous question, the amount was given, the sales amount was given.
Sales amount has been given. We had to inflate that one. Now, I just suggest you to inflate that 3 first. For only 3 years you have to do. So in the first year, hash rate is going to remain 3. In the second year now, 8% has to be incorporated.
Yeah, so 3.24, right?
Let me just calculate. Okay, then on this 3.24, you can calculate.
3.5.
Okay, it's 3.5, rounded it up.
So 3 point.
And calculate the sales. Sales units are 100,000.
Every year same.
Sorry?
Every year it's gonna be same.
Yes, units are same, but multiply with the relevant selling price.
Yeah.
Very simple.
Yeah, I think what.
Yes, dear. Finished? Okay, tell me.
30,000.
In the first year, how much working capital investment?
30,000.
Okay, then
2,400.
very good. Then
600.
592.
2,592.
How?
Maybe you have done some big rounding. Okay, in the last year,
30,000 inflow.
yes, you have rounded it actually. So, yes, in the last year it is going to be reduced, so it is positive, 34,992.
Then wrong.
Yes, you have rounded. So it means that you are now clear about the concept of the working capital flows. Okay, now students, they are telling us that if you are encountering all of the things in your NPV calculation, how are you going to incorporate it? Okay, so because we have considered the tax payable, investment, residual values, tax relief on the tax allowable depreciation and working capital to be incorporated. Okay, so this is what they are telling us, that this format you can be applying in your questions. Because in the exam questions, you can consider all of the things coming in the same scenario. Working capital also, tax relief also, tax allowable depreciation also. So we're here dealing with the questions. What is this? Dealing with questions with both tax and inflation. So this is just the general method which they are just sharing with you. Combining tax and inflation in the same question does not make it any more difficult than keeping them separate. So do not keep them separate, do incorporate them in the same working, okay? Questions with both tax and inflation are best tackled using the money method. Inflate cost and revenues where necessary before determining their tax implications. So as usual, first we are going to inflate the cost and revenues, only then we are going to incorporate the taxation in it. Ensure that the cost and disposal values have been inflated if necessary before calculating tax allowable depreciation. Always calculate working capital on these inflated figures unless given. Use a post-tax money discount rate. Okay, now for taxation, you should be considering that you are using post-tax discount rate. There is a difference between pre-tax and post-tax discount rate. Do you remember from your previous study that what is it? Yes, you are right. You must not have studied it. But in F2 you must have studied it. In F2 you did. Okay, anyhow. Pre-tax rate is without the incorporation of taxation. Actually, we do say that required rate of return is equal to the company's cost of capital. Whatever capital company is collecting, company has to bear the cost on that. Company is bearing cost on that. Say, for example, if the company is getting an investment from the shareholders, it has to bear some cost for that. And that cost is dependent upon the required rate of return from the shareholders. Required rate of return from the shareholders is exactly equal to the cost of capital for the company in cases of shares. But in the case of loan, the required rate of return is not equal to the cost of capital for the company, because company do get the tax relief on the loan. Got it? So in the case of company, it is 1 minus T. The cost is 1 minus T. The tax reliefs are going to be brought in the case of cost of capital for the loan. for the loans, which they are getting from the third parties or from the banks. So that is what they are telling, the discount rate which you are going to use. Please see that this is post-tax. Usually it will be given to you as post-tax, but if it is not given, you need to convert it. And how you are going to convert it? Simply with the discount rate, just apply this. Let's say, for example, it's 10%. So 10% into 1 minus t, this tax is normally 0.3. So 10% into 0.7. Whatever it is going to be the post-tax discount rate. Got it? So this is what they are telling over here. Okay, now here is a detailed question. Determine the NPV of the project. So it is incorporating all of the facts and figures in it. May I just request you to try to solve it by yourself? After 1 minute of you trying to solve it by yourself, I will start doing it over to you, so that you can just compare your answer.
So we start, I should have prayer break.
Okay, sure. Just a short break of 10 minutes. We are going to take, okay? No, Hashif. We need this.
He passed.
Alhamdulillah. In how many marks did she get? Very good. In F?
One now and got over. She last week she got doing harder, like she could get it right. So I told you. One got.
Okay, it's still the same one. Okay.
I don't finish it up first.
Alhamdulillah. Angelica, they are having a prayer break. Okay. If you want to start trying it, you can.
Okay, Miss.
Ashu, you can start doing this question. And Slika, are you doing the question? I feel that you must have finished.
Okay, on easy.
I'm in the middle,
yes.
Miss.
Yes, dear, have you finished?
I'm in the middle. I just finished doing the tax part.
Okay, okay. Where is the AC? Here. But over there it's not.
It's
This-
enough, that's enough for the food. It's
This
here,
is the only window.
it's here, it's here.
Oh, okay. That's what I was thinking. Shall I start doing it?
Masuk. 17 like this. Ini pasang bikin dulu. Okay, sorry.
No, it's fine. Okay, now students, I hope that you have started doing it.
One student is there. I will start.
And Shilpa is also.
So she started, I think this I will start.
Quickly. Need to finish portion.
You told this last question, why you don't have any means?
Because the portion which had been decided to be finished in one lecture should have to be.
Portions are too much. This is the same.
In last lecture, when I prepared only 50 slides, we finished them much before time. So that's why I'm making more slides. Today I have made 78, 75, 75. Life of the project 0, 1, 2, 3, and 4. Okay, Atif, you can also start doing it. Even I'm doing it, you can just compare your answers meanwhile, okay? So, as the project is for 3 years, but I'm making 4 years because of tax incorporation in it. Sorry, for selling price 100,
Yeah, it's 100.
100, and selling price is expected to inflate at 4%.
Yes.
And
That's 0.2.
It is in today's term. So even in the first year, we need to inflate it
Yeah, I got that.
at 4%. Please do your calculations. Okay, let me just do mine. Need to adjust it with the number of units.
Shall we note it out?
Sorry,
Shall we note it out like as we did 160? It would be like, it was 158 variable cost.
sorry, how much?
158. So when we have brought it up.
158 it was
Yeah.
for the first year? Are you sure?
Yeah.
It is how much? 30 per unit, and it is 1.05 increase in it, and multiply by 5. Yes, 158. Sorry, because I might have rounded. It's okay. It's because it's just because of rounding. Is this the same?
Yes, I got that. No, it's 208. That's true.
Other than that, it's fine.
Yeah, that's all.
Okay, net cash flows, tell me. Actually, I just want you people to do it by yourself.
362, 751, 467.
467. Okay, what is the next step? What are we going to do now?
Who's the tax?
Very good.
Step by step is coming, ma'am. They have been step by step, ma'am. The question is
Tax 30%.
109 will start from second year.
Yes, very good. 109.
225, 140.
Sorry, 109, then
541.
then
140.
140. Then what is the next step?
Step is start proceeds.
No, tax relief. You can write stat proceeds as well right now. Actually, I removed it because first we had to calculate taxation. First, you was written in
So
between.
I don't.
Okay, now tax relief, please calculate tax allowable depreciation.
Got it, ma'am.
Have you calculated tax allowable depreciation?
Yeah, first I did the 25% of existing balance.
Just wait. You do your work. It's okay. Ultimately, you do all of your work. What did I do? No one has corrected me.
What?
I have taken on 10,000.
7556.
It's 1,000 only. 187.5. Just do it. That's what I was thinking, that balancing allowance is a lot. Has anyone calculated tax allowable depreciation? The same?
It should be in year one, the tax rebate.
Yes. The year in which the tax is going to be calculated. In the same year, tax rebate. Done? Okay. Ashu, can you tell me the sales value? Year 1, 2, 3. Just tell me, I need to calculate.
Okay.
Year 1,
520,
520 then?
1082,
1082,
675.
675. Okay, then working capital 10% of it,
Yeah, like 52. 108, 68.
1068.
68.
Okay,
Then we
working
go for the
capital.
investment. Requirement of the actual
Yes,
subtraction everything. 52, 56,
then
40. 68.
negative or positive?
Positive.
Very good. Because over here you need to consider.
Then
Okay,
we cost for working capital.
for working capital requirement. Are you getting the same answers, Arthur? If not, let me.
After working capital.
Okay, please do it. Do not sleep then. Arshit, did you do it the same way?
But I have got the answer. I
Oh,
got NPV 255. It's it.
oh, yes, sorry.
255.
255 NPV. Very good.
How much about the special one?
10 mark? I'm still confused.
Still, in which thing, tell me?
I think that working capital requirement, because we are working variable cost. Variable cost is considered as working capital.
No. For working capital, it's written here. Variable cost, it's 30. Variable cost we have done over here. Okay, after deducting variable cost from sales, we have got cash flows. On these cash flows, we have calculated tax, and we have calculated tax allowed by depreciation. Then we have written it over here. Then we are on the step of working capital. Okay, so now we are calculating working capital over there. It's 10% of the annual sales. So on the top, I have written the annual sales, and they are saying about the working capital that this will need to be in place at the start of each year.
How much mark was 10 mark? Don't take my mark.
It can come in the long question this much.
But they do too big para.
Sorry.
Very big para that is there's a small like converted points.
In the exam, when it comes, students to get confused.
It's easy.
Let him concentrate now.
Sure.
Asher, what discount rate did you take?
10%.
10%? How did you calculate?
1 plus I.
Very good. Post tax, because it is pre-tax.
When you do discount working capital, you need to discount capital.
Yes, together we are going to discount. First, we are going to write the working capital requirement. Did you get the same?
Yeah, same.
Okay, now we are going to write it over here. 52, then 56, then 40 positive, and then in the last one, it's 68. Now, net cash flows, whatever you are going to get, apply the discounting factor.
Last one 68 out, because I think
It is going to be released. All of it is going to be released. Here,
30 years will be.
yes. In the last year. Students, for this particular chapter, I have included 3 more understandings in it. Can you do it as your homework? Understanding 10, 11, and 12. Is it fine for you? The remaining 3, this 10, 11, and 12. Can you do it from your homes? Okay. So 10, 11, 12 you can do from your homes. Just finish it and let me know so that we can move on. Atif, if you are confused, let me know. Yes, we need to convert it into the nominal rate with the same formula. And Shrika, how much NPV did you get?
Miss, I got 255.
Okay, great. Asha, did you get the same 250? 255. Sorry? No, it's fine. I do not have any problem. I will take 15 minutes extra. Sorry? 138.6. No. Have you applied the 10% discount factor? Well, how much discount factor have you applied? 6 point? You need to convert it. How?
10% I know does it.
10% you have to apply. Other than that, it's fine. Okay, then you can do it later. Fine. You need to convert it into the money rate. Look, more than 1 inflation rates are given, you need to use money rate. Okay, this is the key I have given you. Okay, now students, you can do the later questions as your homework. We are starting the next chapter, that is asset investment decisions and capital rationing. Again, this is the part of the investment appraisal. We are now going to consider new concepts regarding replacement of the assets. Some assets do require replacement. Then we have to make the financing decisions regarding the asset, whether we will be leasing it or buying it. What should we be doing in different conditions? We are going to consider the concept of capital rationing in the case of divisible projects and indivisible projects. Sometimes the organizations are not able to get as much capital as they do require. So in that case, the concept of the capital rationing arise. What are we going to do in the case of capital rationing where we do not have enough capital to increase shareholders' wealth? In the case of divisible and indivisible projects, what we are going to do. Now, students, sometimes the organization, or most often the organizations, has to consider the fact that they are not able to buy all of the assets. Sometimes they do lease because they do not have enough capital for investing it. So when they should be leasing and when they should be buying, it's their financing decisions, but they should be considering that regarding investment appraisal, it will be bringing on different effects. When we do lease an asset, actually, in the case of lease, the lessee, the person who is getting the lease, the person who is getting the asset is not going to get the tax allowable depreciations because the lessee is not considered as the owner of the asset. So only the owner of the asset gets the tax allowable depreciation, but instead, the relevant cash flows for the lessee would be that on the lease payments, he would be getting a relief. So on lease payments, he's going to get a relief, he or she is going to get a relief, but if the organization is buying an asset, then the tax allowable depreciation will be considered. So this is the major difference. So they are elaborating it over here. They say the NPV of the financing cash flows for both the options are found and compared, and the lowest cost option selected. So in questions, you will be given both of the options. You have to calculate the NPV in the case of leasing. You have to calculate the NPV in the case of buying. And whichever is lower, whichever is most beneficial, you are going to go for that. The finance decision is considered separately from the investment decision. The operating costs and revenues from the investment will be common in each case. Only the relevant cash flows arising as a result of the type of finance are included in the NPV calculation. Now, the decision to buy or lease is in regards to the finance. Making an investment is something separate. So which decision should be gone for? It is the relevant one under financing decision. So you have to consider that both will be having different cash flows under consideration. They say the asset is never owned by the user company from the perspective of the taxman. So the person who is lessee is never going to own an asset. That's why will not be getting the tax allowable depreciation. That's why what is an implication for that? The finance company receives the tax allowable depreciation as the owner of the asset. The person lessor is going to get the tax allowable depreciations, not the lessee. The user receives no tax allowable depreciation, but is able to offset the full rental payment against tax. So whatever lease payments he or she is giving to the owner, that one is going to bringing in the tax relief. So the relevant cash flows in the case of leasing would be the lease payments and tax relief on those lease payments. So these will be the two cash flows if you are leasing an asset. On the other hand, if the asset is being bought, then in that case, the tax allowable depreciations will be there. You can have a scrap value at the end of selling the asset also. So in that case, the relevant cash flows will be the purchase cost, initial investment, any residual value, scrap value, and the associated tax implications due to the tax allowable depreciation. Got it? So in the case of leasing, you will not be getting any kind of tax allowable depreciation. So the relevant cash flows will be the lease payments and the tax relief on those lease payments. In the case of buying, because you are considered as the owner of the asset, that is why you will be having the relevant cash flows as the initial investment of the purchase cost, then any kind of scrap value on which you are disposing of the asset, and the tax allowable depreciation will also be the relevant cost. So what they say, the assumption is that the buying requires the use of the bank loan. Every time you need to consider this thing in your mind, that when the organization is buying, they will be considering the post-tax cost of capital, because they will be considering that for buying, they will be needing a finance which they will be getting as a loan from the third party. So the cost of capital which you are going to use in the case of buying an asset will be 1 minus T. Got it? If you are buying an asset, because it is because of the basic thing that the asset is being bought by taking a loan. So that's what they are telling. The assumption is that buying requires the use of the bank loan for the sake of comparability. The user is the owner of the asset. So what is the implication? The user will receive tax allowable depreciation on the asset and tax relief for the interest payable on the loan. What is tax relief on the interest payable? 1 minus T factor. do not include interest payments or the tax relief arising on them in the NPV calculation, as this is dealt with via cost of capital. So 1 minus T factor will be dealt in the cost of capital factor. You are going to adjust the cost of capital in order to incorporate the tax factor, tax relief on the loan. So how are we going to adjust it? Post-tax cost of borrowing is equal to cost of borrowing multiplied by 1 minus tax rate. This will be converting the cost of capital into the post-tax cost of capital. They say as the interest payments attract tax relief, we must use the post-tax cost of borrowing as our discount rate, as all financing cash flows are considered to be risk-free. Risk-free means that they are not having any kind of risk premium in it. They are not carrying any risk premium. My dear students, actually what happened? The government securities, the government bonds are risk-free. We are not having any kind of risk involved in the government security. That is why the required rate of return is also lesser. But every investment around us is going to have different kind of risk. That risk is known as risk premium. Got it? And that risk premium has to be incorporated. So we are going to discuss this concept in detail in our last chapter, that is cost of capital. And cost of capital, we do have full chapter. So note, in some questions you may find that the company is not paying tax, and so the pre-tax rate would be appropriate. In the questions in which you are going to find that there is no tax being paid over there, you can calculate the question, you can calculate the things by using the pre-tax rate. Otherwise, post-tax cost of debt is going to be used. Simply the cost of capital which will be given to you, in that you are going to apply the factor of 1 minus T. So requirement of the question is to calculate the NPV of the leasing option. So in leasing option, you have to calculate an NPV. Volshape company has already decided to accept the project and is now considering how to finance it. The asset could be leased over 4 years at a rental of 36,000 per annum, payable at the start of each year. Tax is payable at 30% 1 year in arrears. The post-tax cost of borrowing is 10%. So they have already given us the post-tax cost of borrowing. We do not need to incorporate the tax factor in it. Now, my dear students, this question is very straightforward and it is going to be done very quickly, as we have NVT involves. The same amount is going to be used for the predetermined number of years. So instead of doing the detailed calculations, we can simply go for the NVT. We can go for the detailed calculation as well, but it will just be a wastage of time. So we will be going for the NVT now. We are having the rental payments which are starting at the start of each year. How many years are there, students? 4 years. So can we say that from year 0? Because it is from the start of the year. The first payment will be in year 0. If it at the start of the year 1 is just going to be considered, it is going to be converted to the present value as per year 0. So it's year 0 to year 3. 4 years will be there. How much payment is there? Cash flow is 36,000. NVT factor, post-tax cost of debt is 10%. What is the NVT factor? Tell me. For how? Now tell me for which year you are going to see the NVT factor.
1 to 3, right?
Yes. For year 0, it will be 1 plus. What is the NVT factor for year 3? At 10%. It is 2.487. Is it?
Yeah.
So 2.487. What is the present value? Add it for year 1, for year 0 also it is going to be added.
3.487.
Look over here in third year. For 3 years you are getting an NVT factor. But what about the 4th year? It is for 4 years. For year 0 also it has to be added 1. Got it?
3.487.
3.487 multiplied by 36,000.
125.
Sorry, 1.
25. 532.
532. Okay then. Okay then, my dear students, tax is also there. Tax is payable at 30% 1 year in arrears. So for first year it is going to be paid in the second year, and for 4 years it is there. So from year 2, 3, 4, 5. From year 2 to 5. How much payment is there? 36,000. Multiply by 30%. 108,000. Is it there? So 108,000. See the discount factor at year 5. See the discounting factor is 3.791. But now year 2 has to be deducted from it. The first year is going to be deducted. No. If Hashid, you are going to take 1.736, then remaining are 3 only. Remaining are 3 only. So deduct only the first one, 0.909. Calculate it.
2.8.
Okay, then multiply it with 108,000.
31,126.
31,126.
That's much.
Let me check. Yes, because we have used annuities. But in annuities, you need to be careful about this incorporation, which I have discussed with you. Okay, so how much it is, students? Negative
94,406.
94,406. And Sika, are you cleared?
Yes, can you explain again?
Is that tax is payable after 2 years, so we will consider the annuity factor will remove first.
From after 2 years it is being paid, then the first payment will be 30.
So
Third.
we will just first we get it in.
Yes. Then we will be taking the from 3rd year to 6th year it will be. Then we will be taking the 6th year annuity factor, and we will be deducting the 2nd year annuity factor from. Because in collection we have to take 4 years. Okay. Shall we move on? Okay, now understanding number 2. Evaluate the 2 options acquiring the machine and advise the company on the best alternative. Okay, now we have to incorporate the leasing and the buying option both. Evaluate the 2 options for acquiring the machine and advise the company on the best alternative. So obviously these will be about the leasing and buying both. Let's read the scenario. A firm has decided to acquire a new machine to neutralize the toxic waste produced by its refining plant. The machine would cost 6.4 million and would have an economic life of 5 years. Tax allowable depreciation is 25% per annum on reducing balance basis. It is available for the investment. Taxation is 30% is payable on the operating cash flows 1 year in arrears. The firm intends to finance the new plant by means of a 5-year fixed interest loan at pre-tax cost converted to the post-tax, with the principal repayable in the 5 years' time. So this is about buying. Now the second, as an alternative, a leasing company has proposed a lease over 5 years at 1.442 million per annum payable in advance. Scrap value of the machine under each financing alternative will be 0. So now, my dear students, both of the options are not new for you. For buying, whatever we were doing previously, it is for buying. So start doing it. First do for buying quickly, but try to do it quickly. For 5 years it is, you have to make how many columns? 7 columns. From 0 to 6. Because tax is in 1 year arrears. Do it, but quickly do it. Can you do it in 3 minutes?
Is it too much?
It's because you are now aware of it. Leasing is maybe new for you, but the previous thing is not new for you. I will calculate the tax and all the depreciation. Okay.
270, 203.
480,
Yeah.
4.8.
4.8.
Ma'am, I'm doing in hundreds.
Okay.
What's this?
Then make sure that even the initial investment you are doing it the same way.
Uh,
So students, we do not have any other thing. No inflation is there, nothing is there.
Simple question.
Tom, are you doing it in the same way?
Yes, Miss.
Post tax 8%.
7.9.
I mean, yeah, it's not enough.
And then 0.675. Stuck at any point?
No. Post tax rate will be applicable similar to like as we are claiming the possession around 1 year to 2 years.
1 year, no, which one, sorry?
Post tax rate. Post tax cost of capital.
No, I'm not able to understand.
In cost of capital, we will consider in the next year, not in the first year, the second.
No, it's about discounting factor. Cost of capital is related to discounting factor. I told you, maybe you remember, cost of capital, required rate of return, discounting factor. It's the same thing. Got it? So that is, look, 11.4. In this one, 1 minus 0.3. Involve this factor, what you are going to get?
7.9.
7.98. So it's 8%. So 8% is your discounting factor. Just write the reliefs here now. Do not have anything. Reliefs at 30%, we have calculated over there. Just write them and calculate the relief. Ashir, are you doing the next one, leasing?
Yeah.
Okay, great. You can do it again in the form of NVT.
Yeah, that's what I was thinking.
Yes. How much NVT did you get for purchase, for acquisition?
Yes.
Yes. For acquisition for the first part, how much NPV did you get?
6,400.
No, wrong.
Which one are you talking about? Finishing MPV?
Yes, NPV. How much did you get for the first option?
Oh, I didn't calculate it, I'm sorry. I wrote the amounts.
And Shrika, how much NPV did you get?
I didn't do it yet, Miss.
Sorry?
I didn't finish calculating it yet.
Okay, please.
Minus 400.
Very good.
Wow.
Because you are calculating in thousands.
There are points.
Yes. Minus? No, minus 4 point something, 98 something. You should get. Okay, just write the tax reliefs. If you have done it in the same way, the reliefs are how much?
0.48.
Harshit, for the first year, how much? For the second year, we are going to write. Sorry?
0.48.
0.48.
From second year, right?
Yes.
0.36.
0.36.
0.27.
Deducting the element of that 1000. Okay, then
0.27.
0.27.
0.23.
0.23 and
203.
203. And then the last one
0.6.
0.6. Did you get the same, Arthur?
Yes, thanks. 1.15.
No. For year 6, the scrap value is 0. The disposal proceeds are 0. So we are going to get an allowance. On that allowance, we have to take the tax. Got it now? Okay, now we are going to have these cash flows now. On these, we are going to apply the post tax. Now see, Arthur, this is how we are going to calculate the post tax. This is the pre-tax. We are going to incorporate 1 minus 0.3, and we are going to get 8%. So on the 8% discount factor, we are going to discount this. Got it? And that would be our end. Okay, now for leasing option, okay, finish it first. We are going to consider leasing option then. Up till here, your calculations are fine, Arthur?
Yes.
Then it means that you would be able to calculate anything. Now for leasing option, the second option as an alternative, a leasing company has proposed a lease over 5 years at 1.42 million per annum payable in advance. So same from year 0 to year 4, we are going to consider the 5 years payments.
0 to 4 to 6.
I'm writing it shortly here. Lease payments from year 0 to year 4, because yes, from year 0 to 4, 5 payments are going to be
1 year.
for taxation.
6.
It's 1 year in arrears. Okay, so year 2 to 6. Okay, so see the discount factor then. 1 for year 0 and for year 4.
3.312.
3.312. See for year 6.
Year 6 is 3.993.
3.993. Then deduct.
This is 0.99926.
It's 8%. 8%.
4.623.
It's not 3.993. Harsha, you are seeing for year 5.
Oh yeah, ma'am.
So it's 4 point.
So
And for this one also, have you seen the right one?
Yeah, it's right. That's right. First is right for sure. Second one, I was.
3 point, yes. Okay, so for year 6, it is 4.62
those 1 years
minus.
Minus 0.923.
0.926. Calculate, and the lease payment is
3.69.
1.42 is the lease payment, and how much tax is there on it? $1.42 multiplied by 30%, 0.426.
How much?
Taxation 0.426. No, before the discounting.
Oh, okay, okay.
Got it? Calculated.
Um, 157.
Very good. Yes. And the first one is 6.123. Good.
To finish. Now, one more question after this.
Sorry?
That's it. These are short questions.
No, yes, we have some short questions also, like the previous one we did, understanding number 1. Actually, once the practice is going to be built up, then you are going to find all of these questions very easy. It's just about practice. In all of the questions you are seeing, then step by step, we are moving up towards the investment appraisal particular questions. Okay, now students, in leasing and buying, there are some other, things to be considered, but it's just theoretical matters to be considered. What are these? Who receives the residual value in the lease agreement? Any restrictions associated with taking on of leased equipment, that is, leases may restrict a firm's borrowing capacity. Any additional benefits associated with lease agreement, that is maintenance or other support services. So this is just purely theoretical, that we do know that we have to consider the finance issues while taking on the decisions to lease or buy, but some theoretical matters have to also be to consider, that if there are any restrictions on lease, on getting the lease, if there are any restrictions regarding the capital of the company, etc., we need to consider those as well. Now, when there are restrictions, we have to go for the options of EAC and EAB. Basically, these are the same one, equivalent annual cost and equivalent annual benefit. Formulas are also the same. What are the purpose of these? Actually, in the case of replacement decisions, once we purchase an asset, this is not an enough thing. When we do lease an asset, this is not a full stop. We have to consider further implications as well. We need to replace the asset also in the future. And the problem arises where the replaced assets do have different estimated lives. When this is a question, then we have to use EAC. We have to consider the equivalent annual cost. We need to consider the average annuity of the NPV which they are bringing into the company. So once the decision has been made to acquire an asset for the long-term project, it is quite likely that the asset will need to be replaced periodically throughout the life of the project. Where there are competing replacements for a particular asset, we must compare the possible replacement strategies available. So some of the assets may be having a replacement strategy of after 1 year, we can replace the asset after 2 years, we can replace the asset after 3 years. We have to compare all those replacement strategies. And whichever is the best one, we have to go for that. A problem arises. Now, where the problem arises when equivalent assets available are likely to last for different lengths of time. One replacement may be lasting for 2 years, the other can be for 2 to 3 years, the other one can be for 5 years, etc. An asset once bought must be replaced at regular intervals. This is again a problem, and the decision we are concerned with here is how often should the asset be replaced? How often we should be replacing the asset? Obviously, the option which will be giving us the highest benefit, we will be going for that. So we will be using EAC in that case, that is equivalent annual cost. So what is the formula to be used in that case? Present value of the cost, you can just consider it as NPV. NPV divide, sorry. This is not a taxation paper. So this is not going to be given, okay? Only few formulas will be given to you in your F9 exam. Anyhow, NPV divided by NVT factor is your equivalent annual cost. So the same formula will be used in the case of EAB also. Equivalent annual cost is equal to NPV divided by NPV divided by NVT factor. They say in order to deal with the different time scales, the NPV for each option is converted into the NPV factor or an EAC. So first, for all the replacement strategies, you are going to calculate the NPVs first, then you are going to calculate the EAC. Whichever is going to be the suitable one, you are going to go for that. Which one is giving you the higher accurate result, you are going to go for that replacement strategy. The EAC is the equal annual cash flow to which a series of uneven cash flows is equivalent in present value terms. The optimum replacement period or cycle will be the period that has the lowest EAC, which is giving you the least EAC, highest benefit available, although in practice, other factors may influence the final decision. In the exam situation, you are going to see the lowest EAC, but in the practical situation, obviously the other matters are also going to be considered. So what you have to do, the method can be summarized as follows: calculate the NPV for each strategy, a replacement cycle, calculate the EAC for each of the strategy, and choose a strategy with the lowest EAC. So first you are going to calculate the NPV for all the replacement strategies. Then you are going to apply the formula on all of these. Whichever is giving the least EAC, you are going to go for that.
So it's just the one step extra is really.
Yes, you can consider. Okay, now what are the assumptions which you are going to take in the case of EAC or EAB2? Cash inflows from trading are ignored. Cash inflows from trading are ignored since they will be similar regardless of the replacement decision. In practice, using an older asset may result in lower quality, which in turn could affect sales. When you will be given the questions for EAC, normally the trading income will not be there. The operating efficiency of machines will be similar with different machines or with machines of different age. So in replacement, obviously, practically, when you are going to apply the decision, you are going to see that what is the efficiency of the different machines. But over here in the exam situations, you are not going to consider the efficiency. You are going to consider that efficiency of all the machines, of all the strategies under consideration is the same one. The asset will be replaced in perpetuity. It is going to be done in the perpetuity for a long period of time, for an indefinite time period it is going to be done. This is the meaning of the perpetuity, or at least into the foreseeable future. In most questions, tax and inflation are ignored. When you are going to encounter the questions regarding EAC, you will not be having the tax and inflation factors over there. As with all NPV calculations, non-financial aspects such as pollution and safety are ignored. An older machine may have higher chance of employee accidents and may produce more pollution, but it is going to be ignored. Then note that if required to compare different sets of cash inflows with different lifespans, and equivalent annual benefit calculation can be done using the same principles. So EAB is also going to be done using the same principles. Now here is a question. Quickly, we are going to see that how can we apply the principles of EAC. Requirement of the question is to calculate the optimal replacement cycle if the cost of capital is 10%. So my dear students, you can see the scenario, read it. Yes, sir. What is the first step? You have to calculate the NPV for different replacement strategies. What is the next step? Apply the formula. That is NPV divided by NPV factor. And what is the third step? The strategy with the lowest EAC has to be selected. So let's read the scenario. A machine costs 20,000. So the initial investment is 20,000. The following information is also available. Running costs payable at the end of the year. Year 1 is 5,000. Year 2 is 5,500. Trade-in allowance, if disposal is going to be after 1 year, the trade-in allowance is 16,000. You can consider it as a scrap value. Disposal after the 2 years, and the trade-in allowance is 13,000. You have to select between year 1 and year 2, whether you should be replacing the asset at year 1 or you should be replacing the asset at year 2. In the first case, 0 year and first year is going to be considered. Make 2 columns, 0 and 1. For the first case, make 2 columns, year 0 and year 1. Okay, in the case of year 0, in the case of 1 year, how much running costs are there? Initial investment is 20,000. Initial cost, initial investment. Then my dear students, running cost. Running cost is how much?
Running cost 5,000.
5,000. Then disposal
16,000.
is 16,000. Calculate the cash flows. 20,000. How much it is? 9,000.
11,000.
No, yes, 11,000, sorry. Apply the discount factor.
11,000.
How much it is? 10%. Calculate the NPV. Same do with the second strategy. In that one, you will be making 3 columns because 2 years are under consideration. Initial investment is how much? 20,000. Running costs are how much? For year 1 it is 5,000. For year 2 it is? No, for year 2. Now we are considering 2-year strategy. So second year running cost should also be to consider. It is 5,500. Then trade-in allowance is how much? 13,000. No. Now look, we are considering that whether we should be replacing the asset after 1 year or after 2 years. If we are replacing it after 1 year, then the trade-in allowance after 1 year is going to be considered. This one, if we are disposing it after 2 years, then second year disposal allowance is going to be considered. Got it? So it is 13,000. So calculate the net cash flows. Apply the discount factor of 10%. Calculate the NPV.
First case it is 10,000 negative.
10,000, very good. And for the second case?
Second case it is 17,500.
No, 18,350. Yes, what is the net cash flow?
Sorry.
Minus 20,000.
I will discount factor, so.
Which discounting factor did you take? 10% for both of the cases.
Yeah, but the second one we have taken. Second year. There is a change question.
Yes. For the second year also you have to take a discount.
$18,350.
18,350 for the second case?
Yeah.
No, yes, 18,350, very good. Okay, so for the first case, how much it is?
10,000 negative.
10,000 negative. For the second case, it is 18,000 negative?
Negative.
18,350. Calculate the EAC equivalent annual cost. 18,350 divided by NBT factor. NBT factor for 2 years, please see in 10%. For this one also 10,000. See the NBT factor for first year in 10%.
199. 10%.
Here, no. NBT factor. You are saying present value.
Yeah, I will enter for the 10,000.
For this one, how much it is?
0.909.
Are you sure? Is this NBT factor?
Yeah, that's.
Okay. 0.909. Okay, how much it is now? 10,000 divided by 0.909. Okay, then the other one, yes. Atif?
01001.
This one?
010.
11,001. Okay, and this one, what is the NBT factor for 2 years at 10%? 1.736. How much is EAC?
10570.
10570. So this replacement strategy is giving lesser loss, second one. So we should be going for the second to replace the asset in second year. Let me confirm. 10570. Yes. And 11002. Okay, fine. And Shrika, did you get the same answers? So we will be going for the replacement strategy for year 2 as it is giving us lesser loss. Okay, now students, we have understanding number 4. Again, to calculate the optimal replacement policy at the cost of capital of 15%. Students, the same type of the question is there. I just want to request you people to do it by yourself. Now over here we have 3 replacement strategies, year 1, year 2, year 3.
So 3 cases, right?
3 cases. Angelika, try to do it by yourself, dear.
Yeah, Miss, I will.
We would be able only to finish this chapter, not the next chapter today, I think. So, can we, for Thursday, okay, please confirm and let me know that on Thursday, do you want an online class or not? Or if it's fine, even if we are not going to have a class in the next week, in the next week we could cover, we can cover it, no problem at all. But in this week, because you are going to have a long break, please do practice this investment appraisal, okay? From exam point of view, regarding investment appraisal, the questions which we have done earlier to this one are very important, including tax incorporation, including inflation and working capital. That is very important. We can see it in the long question also. These can come in the short questions.
It's maintenance cost.
Sorry?
What we do with maintenance cost, it ladder with the first year, second year, right?
For which year strategy you are thinking?
Second year, there's a maintenance cost. So
Yes, 1500 in the first year, yes.
and it also includes 7,500, right?
Yes, that is the trade and
Okay,
allowance.
and yeah, got it.
You are going to take 0, 1, 2. 1500 will be in the first year, trade and allowance is in the second year. Is there any confusion? Yes, dear.
Yes, it says continuous cost of the second year. So it means there is no cost of the third year. Where is it?
No, no, not in the third year.
Oh, yeah. Yeah. Yeah.
For this 3-year replacement strategy, you will be having year 0, 1, 2, and year 3. And in the second year, you are going to take the maintenance cost of 2700. In the third year, you are not going to take any maintenance since there is maintenance. And you are going to take the trading allowance in the third year.
Only.
Yes, 7,000.
What is the second one's NPV? 1017?
Okay, let me check. I'll let you know. For the second one, NPV is 7635. Okay, let me just do it. For the first phase, if it's after 1 year, year 0 and 1, initial is
So
12,000.
EAC, I forgot, EAC. What is EAC?
Sorry?
EAC.
Yes, ES you need to calculate. Okay, then initial investment and then maintenance costs. Here, there are no. Trade-in allowance is 9,000. This is for your strategy number 1. For strategy number 2, 0, 1, 2, initial investment will remain same, 12,000. Then maintenance cost in year 1 is 1,500. Trade-in allowance for second year will be 7,500. So this is for the replacement strategy for 2 years. For the third case, 0, 1, 2, 3. Initial investment will remain the same. Maintenance cost is 2,700. In the first year, it is 1,500.
Yeah,
In the second year, it is
it is 7,500.
2,000.
7,500.
In the second year, it's 2,700.
Third one.
In the third year, we do not have
Third one, sorry.
trading allowance.
7,000.
Yes, 7,000. This will be. Now compare your answers.
Yeah, got it.
This is for the third year replacement strategy.
The separate one.
We are going to finish it before today. We are going to finish.
What's the final one? The one is 4704. The cheapest one is number 2.
Number 2 is the cheapest one. Let me see.
Cheapest lowest side.
Yes, after every 2 years. Yes, where are you confused, Arthur? Are you able to see it?
Yes, yes. 15% getting.
15%? Yes, 15% cost of capital. Then you have to calculate EAC for all the 3 options. Done?
First one is 6297.
Let me check it.
Then I got 4793.
EAC. EAC for the first one is
6297.
47.
no 4793. Have you done the calculations in the same way? 12,000 for year 0 and for year 1, 9,000. Okay. Harshit, please. Yes, please tell him. And Stika, can you see the whiteboard? Did you do the question in the same way as I mentioned on the board?
Yeah, miss.
Okay, okay, great.
I just got confused with the maintenance part. I didn't.
Sorry?
Give me some time to do because I didn't see
Okay,
the
okay,
maintenance
sure.
part.
Second year, shall we consider the cost of maintenance?
No. Which one? In this one? In the 2 years replacement?
Yeah, and while calculating the net present value.
Here?
Yes, in second scenario.
No.
It is saying the second year cost of maintenance is 2,700.
1,500 in the first year.
Yeah.
In the second year,
2,700.
2,700 in the second year. But note that the asset is only maintained at the end of the year if it is to be kept for the further year. So we are not keeping it for the further year. Got it? So that's why we have not taken it over. Harshit, got it?
Yeah,
Look, in the note they have mentioned, can you see the note? We could have taken it because for the second year it is there, but they are mentioning is only maintained at the end of the year if it is to be kept for the further year. Since we are not keeping it for third year, that's why we have not taken. Over here we have taken for 2 years because we are keeping it for the for those years. Got it? Shall we move on? Okay. Now, students, what are the limitations of the replacement analysis? We do not consider the factor of changing technology in it. We are not considering the factor of inflation in it. We are not considering the changes in the production plans. So these are the basic limitations for the replacement analysis. Now we do have equivalent annual benefit as well, EAB. That is the formula. You can see the same formula is there. NPV of the project divided by NVT factor. And in the exam, whether they can ask you to calculate EAB or they can ask you to calculate EAC, both of them can be asked and you have to follow the same strategy. They say the equivalent annual benefit is the annual NVT with the same value as the NPV of an investment project. It can be calculated using a similar formula to that you have used for equivalent annual cost. Calculating the EAB is particularly useful when trying to compare projects with unequal lives. So normally we are using the EAC also with the projects of the unequal life, the project with the highest. Now, only the difference arises here. The project with the highest EAB would be preferred. This is about benefit. That was about cost. That is why the least EAC has been selected over here. The highest economic, annual benefit project is going to be considered. Anyhow, they have not considered any of the examples for EAB since the formula is going to be the same. Now we are going to consider the concept of the capital rationing. My dear students, you can consider the capital rationing concept as the limiting factor analysis. Do you remember from your F5 studies or your F2 studies, you have considered about limiting factor? There are some factors which are going to limit the operations of the organization. Organization's basic agenda and objective is to increase shareholders' wealth. But sometimes it is not possible because the organization has lesser production or any kind of the limiting factors are there. Is it fine for you if I take any 10 to 15 minutes extra? Okay. So this is the concept of capital rationing. Since the organizations do want to invest in all of the projects available because they have lesser capital investment present, that is why they would not be able to do that. That is why they have to choose only those projects which are as per their available capital. So here the capital rationing concept arises. We do have two types of capital rationing, hard capital rationing and soft capital rationing. Hard capital rationing is because of the outside factors which are present outside the boundaries of the organization. Say, for example, the bank authorities which are going to give the capital to the organization, they are not agreeing to do that. Maybe the credit standing of the organization is not good, or whatever, the government has imposed any restrictions, or whatever the case is. Soft capital rationing factors are going to arise when inside the boundaries of the organization, there are some factors which are not allowing the organization to make the capital investment as per their wishes. Say, for example, lesser income capital is present, they want to give the dividend to the shareholders, etc. So what they say, quickly read it, shareholders' wealth is maximized if the company undertakes all positive NPV projects. Capital rationing is where there are insufficient funds to do so. This implies that where the investment capital is rationed, shareholders' wealth is not being maximized. Ensure you are able to discuss the difference between hard, external, and soft, internal capital rationing. What is hard capital rationing? An absolute limit, the complete limit on the amount of finance available is imposed by the lending institutions. And soft capital rationing, a company may impose its own rationing on capital. This is contrary to the rational view of the shareholders' wealth maximization, because shareholders being greedy, being the rational persons, they every time want to invest in the NPV project since they do want their wealth to be increased. Now, the reasons for the hard or soft capital rationing. For hard capital rationing, there can be many industry-wide factors limiting funds, or the company-specified factors also. Because of lack or poor track record, credit standing is not good one. Lack of asset security, the asset which has to be given as a security to the banking institutions is not available. Poor management team can also be the factor giving rise to the hard capital rationing. What can be the reasons for soft capital rationing? These are going to be confined only to the inside boundaries of the organization. These can be limited management skills available. Management is not skilled enough to solve the capital rationing issues. Desire to maximize return in a limited range of investments. Management does not want to invest in most of the projects. Maybe they are risk averse. Limited exposure to the external finance, or encourages acceptance of only substantially profitable business. So in short, management is risk averse. They are not trying to put their investment into multi-projects. Now, capital rationing can be single and multi-period. As you can remember, the concept of limiting factors. Limiting factors can be any one, or they can be more than one. So in both of the cases, you have to prioritize different kinds of investment opportunities. Whichever is giving the highest NPV, you are going to invest in that particular one. So single period capital rationing is going to last for one period only, but multi-period capital rationing, this is not in your syllabus. It is going to be lasting for more than 1 year. The method of dealing with single period capital rationing is similar to the limiting factor analysis used elsewhere in the decision making. So you are going to calculate the profitability index of different investments available. You are going to prioritize them. You are going to give them the ranking. And according to that, you are going to invest in them. So let's see further. The profitability index and divisible projects. We are going to prioritize the projects as per the PI calculated for them. What is PI? How are we going to calculate it? It's NPV divided by investment. NPV divided by investment of all the projects is going to be calculated. And according to this answer, we are going to prioritize the project. And on those projects which are having the high ranking, we are going to invest the amount first and later for the different stages. So sometimes there are projects which are divisible. Sometimes the projects do need the full investment, full required investment. Otherwise, they would not even be started. Some projects are of such type that they would be completed even. They would be initially started if the initial investment would be given to them. So those projects which can be done in part are known as divisible projects. Anyhow, we are going to use PI index for the projects which are divisible. Those projects which are indivisible, we are going to adopt the method of trial. So first look at this one. They say, is my speed okay? Is it fine? Or am I speaking so quickly? Is it fine? Sure? Okay. If a project is actually, I need to finish. If a project is divisible, if you want, we can finish it later. If it's disturbing you, or if you feel that I'm doing very quickly. Fine? Okay, if a project is divisible, any fraction of the project may be undertaken and the returns from the project are expected to be generated in exact proportion to the amount of investment undertaken. Projects cannot, however, be undertaken more than once. The aim when managing capital rationing is to maximize the NPV earned per $1 invested in the projects. Where the projects are divisible, it can be done in part. Earn corresponding returns to scale. It is achieved by calculating a profitability index for each project by using this formula, ranking the projects according to their profitability index, and allocate the funds according to the project's ranking until they are used up. Unless the capital is finished up, we are going to invest them in the project which are giving us the highest profitability index. Now here is the question, the requirement of the question is to determine which projects should be chosen to maximize the return to the business. So first step, we need to see that whether the projects are divisible or indivisible. Over here, as this is the question for the divisible projects, they are not mentioning it over here. In the exam, when they do want to specify divisible projects, they are going to tell you in the question itself. Anyhow, a company has 100,000 available. Only 100,000 is available for the company for investment and has identified the following 5 investment opportunities in which to invest. All investments must be started now, that is year 0. So we are going to rank all of the opportunities by calculating the profitability index. What is the formula to calculate profitability index? NPV divided by initial investment. So calculate profitability index for every project. 35 divided by 100, 24 divided by 50, 18 divided by 60. This one is not going to be considered since it is having an NPV of negative NPV. So how much profitability index you are getting? Sorry? 50? No, do not multiply with 100. 0.5. Then
0.35.
0.35. Then
0.48.
0.48. Then 0.3. Okay, now we are going to rank. Which one is going to be on the highest priority? Project C, having the highest profitability index.
C, then E,
Then the second one, third one,
D.
fourth one,
Of course, that's the
the last one. And G is going to be ignored. Now what we have to do, what is the next? We have to see how the project is going to be finished. Total amount which is available to us is 100,000. It is going to be invested first in which one? Project C. How much initial investment is required for that? 40,000. Project C. The remaining amount is 60,000. On the second priority, which project is there? Project E. So 50,000 on project E is going to be invested. How much is remaining? 10,000. Now, which project is on the third priority? It is project D. But it can be initial investment for it is 100, but it is a divisible project. So we have only 10,000 remaining. So how we can invest 10,000 out of total 100,000, we can invest 10,000 on project D. Got it? So our investment is finished, but we need to see that how much of the project D is going to be completed only. 10,000 out of 100,000. How much?
10%.
10% of it is going to be finished only. Got it? To determine which project should be chosen to maximize the return to the business. Now, this is the case for the divisible projects. If the projects are not divisible, that last 10,000 would have been lost for us. Got it? And this is the major difference between divisible and indivisible projects. The last amount will be 0 because we just assume that it will be giving us an amount or inflow equal to the cost of capital. So it is going to be lost. Got it? Okay, now indivisible projects are going to be decided upon on the basis of trial and error. So only short discussion is left. We are going to finish it in our next lecture. And I just suggest you people to go through all of the exam kit questions, because doing exam kit is very much important. Towards the end, we will be doing the mock exams. But telling you very honestly, we would not be having the time to go through all of the questions of the exam kit. As you can see, it's near to impossible. So do the exam kit questions whenever you want to have my help. I am already available for you people. Okay, you can just take a picture of the question. You can just send me that, ma'am, we are not understanding it. Please let us know. Okay. So this is all for today. And Shrika?
Yes, Miss.
This is all. Sorry? Yes, on Saturday we will be having a class. Okay, now on Saturday, we will be finishing the last chapter related to the investment appraisal. That's great. Actually, I forgot it. Skipped out of my mind. I'm happy now that on Saturday we have a class. We are going to finish this and we are going to do 2 chapters from working capital. The next topic which we are going to start, it's working capital. It's far easier and very lesser complex than as compared to this investment. This was not also a complex one, but that one is very easy because working capital is going to have the concepts of that ratios. Do you remember the concept of ratios? In F5 you have discussed, in all the other subjects, in F2 you have considered them. So that is going to be repeated in the chapters of the working capital. So that one is a very easy portion of your trip. So next we are going to start.
I mean, can we maybe 10 o'clock, which is the 9:30?